Now let's have a look at the impact of taxes. The major purposes of taxes are the following from an economic point of view. They're to raise revenue to fund government expenditures, to redistribute income between households, and also to manipulate market outcomes, either to correct or decrease a market failure or to improve the market welfare outcome for one group or another. What we're going to be looking at here, of course, is none of these purposes in and of themselves. We're just going to look at a scenario where a tax is imposed, and we'll see what kind of impact that has on a perfectly competitive market. We should note that taxes can result in a deadweight loss of economic welfare in perfectly competitive resource markets, but it doesn't necessarily mean that there is a loss of welfare to the society overall. That will depend on what's done with the tax revenue. For example, that tax revenue might be used to eliminate or reduce a deadweight loss in another market, in which case, although a deadweight loss might be created in market A, the revenue generated could be used to eliminate a deadweight loss in market B. Now, if the overall for the society, so to speak, the deadweight loss decreases, then we can say that it's been a welfare improvement. Now, a tax can obviously be imposed on either buyers or sellers of a product. Where a tax is imposed on a buyer or buyers, it shifts the demand curve or the marginal benefit curve downwards. In the case of sellers, the imposition of a tax shifts the supply curve, or the aggregation of all the marginal cost curves, upwards. But the incidence of the tax, that is, who actually pays what share of the tax, can fall on both parties. Now, when we think about this graphically, we'll see that the tax acts as a kind of wedge. So, from the perspective of buyers, it pushes up the price per unit that they pay. And from the perspective of sellers, it pushes down the after-tax price, the revenue per unit, that they receive. So, just to get the idea of how this wedge works, let's say we're imposing a tax of $10 per unit. Now, whether it's on the buyer or the seller is, in graphical terms for our purposes right now, beside the point. What we're doing is we're just taking our $10 tax and we're going to wedge it into the gap between the supply and the demand curves. So when it's wedged in there nice and tight, that tells us the quantity due to the imposition of the tax, whether it's on buyers or sellers, the quantity that will be bought and sold. And it tells us that the equilibrium price, which was 100, has been, well, it's no longer an equilibrium price, but effectively the buyers are paying now $105, whereas the sellers are receiving $95 after tax, because that tax money, that gap, that wedge between them, goes to the government. So let's see how this works in terms of shifting the curves. Let's say a $10 flat tax is imposed on buyers of smartphones. So we've got that's our $10 there. We're going to wedge it in there. Now this tax is going to, since it's on buyers, it's going to push down the demand curve for the product. So this is demand minus the tax. We can see there that because of the imposition of the tax, the new equilibrium price is going to be $95. And that's the price that sellers will receive after tax. The buyers, on the other hand, will be paying $105 because of the imposition of the tax. So the sellers will receive $95, but the buyers will be paying $105. You can see there that the tax revenue will be the $10 per unit, or $10 per unit, multiplied by the number of units sold, which is 2,000 in this case. So that's $10 per unit times 2,000, which will be $20,000 in revenue. Bear in mind that there's no indication here in this simple analysis of why the government has imposed the tax, whether that is it's designed to generate tax revenue for some purpose or other, or whether it's designed to manipulate the market for this product or not. We don't know. But we do know we can use this analysis to try and understand what's going on. If, on the other hand, we said that there was a tax imposed on the sellers, that will push the supply curve up by $10. It's a flat tax at every point on the supply curve. So there's our $10 again, and we're going to wedge it in there, and it pushes the supply curve up. So now we can see that the new equilibrium due to the imposition of the tax, the buyer's price will be $105, but the after-tax per unit revenue received by the sellers is $95. It's the same situation as before, except in this case, instead of shifting the demand curve down, we've shifted the supply curve up, because the tax has been imposed on a different group. The overall outcome, however, you'll note is, in the way we've drawn it here, it's exactly the same. Again, the same tax revenue is collected.